AI mania is leading to some highly bullish views on single stocks, expressed through the options market, where calls are increasingly outnumbering puts by a factor of 1.75 to 1, a historically high ratio. Here to break down what this means for investors is Jessica Inskip, OptionsPlay Education Product Director, and Yahoo Finance's Jared Blikre. Take it away.
Thank you, Brad. Jessica, great to have you here once more. We're going to get into some trades in a second, but I wanted to start with this chart. This goes back to 2015, and it shows the volume of call options versus put options, and we're seeing a lot of call options right now. Not anything near what we saw in 2020 rolling around GameStop, but just give me your thoughts on where we are in the environment right now.
Yeah, just like we pull consumer sentiment numbers, that actually, I believe, came out today.
Yes, a little bit of disappointment.
Yeah, but options can give us also another view, which is a little more specified or niche down. So this is telling me that there's still positive speculation within those options traders specifically. So it's an indication of bullishness within that specific niche of traders.
Well, and bullishness is what we've been seeing in the market lately. Just want to review real quickly for our viewers, because this is an educational segment, calls and puts. You can buy a call, you can buy a put, you can also write it or sell it, and this expresses different views, bullish or bearish.
That's right, yep, and you can be on the short side, so selling and be bullish. So if you have an obligation to buy, and the quick way to remember this is anything that contains a buy, obligation, or right to execute is bullish, a sell is bearish.
All right, buy bullish, love it. All right, here is a trade we're looking at. We're calling this in a new segment, Trade with Congress.
Yeah.
Palo Alto Networks was in the news yesterday. Here we're talking about a trade getting into it, but this is a very interesting way. You're buying a deep out of the money. That is, the strike price is much lower than the current price, all the way down at 200. Why this number and why this trade?
Yeah, so very deep in the money, so very, very deep. So Palo Alto right now is around 316. This is a 200 strike. So a long call represents the right to buy 100 shares of Palo Alto at $200 a share. If it's at 315, that means it's at least $115 of intrinsic value. Anything of excess is that extrinsic value component that you have to overcome. But something happens when a stock or an option is very, very deep in the money. It starts acting like the stock.
So you don't have to worry about that theta decay because you're not overpaying for that premium.
Exactly,
in theory.
And this is very long dated. So this was Miss Nancy Pelosi's trade yesterday, the January 17th, 2025. But it's a way that options can utilize leverage to still have that long stock exposure, but not have that major theta decay. And that's essentially what this is. This is considerably cheaper in terms of price in comparison to buying 100 shares of Palo Alto.
Very interesting. Now we want to get into a little bit more of a complex trade, but this is simply a cash secured put. This is an option strategy where an investor sells a put option while setting aside the cash to buy the underlying stock if the investor is assigned. And we want to get into the trade, so we're just going to have to skip past these pros and cons. And here is the Apple cash covered put chart. You're looking at a strike price of 180. Can you break this down for us?
Yeah, so the long call, we're speculative. We are expecting a large upward or sharp directional movement. With this, a good contender for this type of security is something that's range bound, or you're waiting for it to break out. You don't expect it to go too high. So instead of we having the right to buy, we have the obligation to buy. So we're selling a put. We want it closest to the money as possible. So which means the current strike, the current market price, 180, about a 45 days until expiration. This one's about 39. What we do here is we actually keep all of the upfront premium, which is about 343, but now time's working in our favor, but we have the same risk as owning the stock.
Which is the price could go to zero.
It could go to zero, but that's what would happen. We do this to actually utilize the obligation found within the short put in order to buy the shares of Apple. That's completely the intent. And in comparison of buying it at 180, you actually get it at a discount at 343.
There you go. We got a little bit of time left, and we're just talking about some of the pros and cons in options trading, but I want to tie it back to the current operating environment, back to what we were talking about in the beginning. We're seeing a lot of bullish frenzy, well, a little bit of frenzy. What do you think, when you're scanning for options, when you're looking for trades each day, what is going through your head to filter them?
Yeah, so it always starts, you have to understand an option as a derivative. So it is derived from the underlying security. So we have to know what our investment thesis is for that underlying stock. Is it an earnings play? Is it something that we're looking for momentum? Or is it something that we want to add to our longer term portfolio? And these were two examples of longer term trades based on the stock perspective. But that's when time and implied volatility comes into play, and you have to know the positive and negative factors, which we touched on.
Yes. A very comprehensive interview here. So thank you. Thank you for stopping by, Jessica Inskip, the OptionsPlay Education Product Director.